Good evening, everyone. Welcome to Atlantic Federal Credit Union's virtual homebuyer seminar. We're excited to be able to share some information and helpful tidbits when it comes to buying a home. And just a little side note that we can't see or hear you, but at the end of the presentation, you will be provided with our email addresses. And if we certainly have time, we're happy to answer any questions for you. But first off, I'd like to introduce myself. My name's Lori Goodrow. I am the Mortgage Business Development Officer here at Atlantic Federal Credit Union. And as you can see, my NMLS number is 746916. And also, I've worked in the lending industry for 25 years. Actually, I started my career here when it was York County Teachers Federal Credit Union back in 1996. So let's not do the math on that. I don't want to. So without further ado, I am happy to share this information. I'm very excited and I wanted to get into some basics. I am so thankful that you all wrote down or submitted some questions and concerns and really what you're interested in. And I know a lot of you are first-time home buyers and the question is, I don't know where to start. And that is what we're here for. So the first slide is really obvious, but I like to put it on there because I just feel that it's not appreciated sometimes, that buying a house is a big deal and people get nervous, they don't know where to start, and that's all just very normal. If it wasn't a big deal, we wouldn't be here. So it is obviously one of the biggest financial commitments that a person can make, hands down. It's not like buying a vehicle where you can just walk into a dealership and you say, I want to buy that car. And then you say, I want a car loan. And you get a car loan in about an hour. Maybe nowadays it's more like 3 hours. But you walk out with your vehicle and you walk out with your loan. And it can be as simple as that. Mortgages are a whole different can of worms. There are so many facets. There's so many conditions. There's so many factors. And understanding the steps can definitely make for a better experience. And that's what we're here for. So the number one thing that I like to start off with, especially when I'm talking to a borrower, is know your budget. And again, I know that sounds so simple, maybe kind of cliche if you're watching too much of the Dave Ramsey shows and all of his YouTube videos. But it's true because, as you can see from the first line, you need to have a monthly payment that you can afford. And when people call me or they contact us and they say, looking for a house, I'm brand new, I need to know what I can afford. And boy, that is a question that I circle right back and I say to them, well, I can tell you what you can qualify for, but really only you know what you can afford. And why do I say that? Because what you can afford is different than what you qualify for. I will say that again. What you can afford for a mortgage is going to be completely different than what you can actually qualify and get approved for. Why is that? Well, you've probably heard of the acronym debt or DTI, debt to income ratio. Us mortgage lenders, we love to throw out these type of acronyms. And you say, okay, debt to income ratio. Okay, great. What the heck does that mean? Well, it means that when you're applying for a mortgage, say you $300,000 and the payment's going to be $2,800. Okay, $2,800. When we calculate a debt to income ratio, we are basing that on your gross monthly income. And for those who get straight W-2 income, you get your paycheck, right? Wouldn't that be great if you made $60,000 and you actually took home $60,000? No, you're going to look at your pay stub and you see that you have your insurance taken out. You might have your 401k contribution taken out. You have your dental insurance taken out, Social Security, Medicare, everything. And then you have your net pay. Well, your qualification is not based off of your net pay. It's based off of your gross income. That is a huge difference because it varies from person to person. You could have somebody who makes that same 60,000 and doesn't take insurance. Maybe they're on somebody else's insurance and their 60,000 is just maybe taxes taken out and that's it. Then you have somebody else and they're contributing 15% to their 401k. They take every single insurance and Aflac, everything that you can think of coming out of their paycheck. So you see what I'm getting at as far as your net pay is going to be different, yet we're qualifying based on the gross income. So if that just makes a big difference as far as borrower A and borrower B. So what you can afford is also completely different. You might be somebody that you love being home and you don't mind most of your paycheck going towards home expenses. And we have several people like that, and that's great. Or you may be the person that your lifestyle is you like to go out to dinner several times a week. We all like to go on vacations. We all like to go snowmobiling up north, and we all know that takes money. So you can easily suck up some of your home budget by doing those things. So we don't know that. So that's, again, why I kind of circle it back to the borrower to say, we can tell you all day long that you can afford a payment of X amount or qualify for it, but it doesn't mean that you can afford it. So I can't stress that enough. And I feel like sometimes it's too robotic, especially if you're applying online and you can get an instant pre-qualification on for a national lender's website because you're plugging in this info and they're saying, yep, you can afford it. Think about that. And I tell my borrowers, especially the people that don't have any housing expenses right now, if you're living with your parents, or maybe you're living above somebody's garage, like in an in-law apartment, and you're only paying $500 a month in your budget, and you're used to paying $500 a month. Well, there's a concept called payment shock in our world that you're all of a sudden going to be having a $2,800 payment and you're used to paying $500. And oh, by the way, you have to pay for heating and electricity and all of these utilities that maybe you haven't been paying for before. So I like to tell borrowers that if you don't really know, do a mock budget. Pretend that you have a $2,800 payment and see what your lifestyle is like in that next couple of months while you're doing it. If you feel poor and you are struggling, then you're going to know that you need to make some adjustments in your budget, but you're doing it before you actually buy the house. And that's the trick. So know your budget and, as you can see, know your credit score situation. And we hear that all the time, credit score, credit score, credit score, credit score. You have a Chase card, you get an email, I just got one the other day. Your credit score has been updated. It's every month. And you look at it and like, am I bad? Was I doing something wrong? No, it changed by 2 points. Credit score monitoring is great for trending, but it's not your one-all be-all credit score. As you can see, there are all different types of scores. So, and that is important to know when you're beginning this process, because you can go on Credit Karma and say, I've had somebody call me and say, well, I know that I qualify because I am a 679 credit score. Great. But that was their Credit Karma score. So plug in their information. Lenders are going to pull a tri-merged credit report from all 3 bureaus, Experian, TransUnion, and Equifax. And we're going to pick the middle score. Everything is priced off of the middle score. But it's a different FICO model. It's FICO model 5. Well, what does that mean? It's a different algorithm. Okay, so what does that mean? It means it's going to be different than the Credit Karma and the one on Chase and your Discover card monitoring. And it's going to be different if you were to go to into the credit union branch and get a personal loan. They run a different FICO model. The dealerships run a different FICO model. It gets really confusing. So you think you have a number in your head and you see, oh, I need a 640 to qualify. I'm a 640. Well, not necessarily, maybe not in the mortgage world. So be mindful of that. And it can really make a difference in the process of knowing ahead of time what your score is. So I also put on here, get your free credit report from all 3 credit bureaus. You are allowed 1 free credit report as a consumer through TransUnion, Equifax, and Experian. So I put annualcreditreport.com because that brings you to all 3 of the bureaus. It doesn't give you an automatic credit score. I think it asks you to pay for one, which I wouldn't, but it gives you the information on there just so you can see, are there any collections that are on there or something like that? So that can be very helpful. So at the end of the day, know your budget and get a grip on credit. So where do we go from here? You're thinking you want to buy a house. Seems a little scary because you're not even sure what to do. So what do? You start with us. You start with the lender. So if the next step as far as doing that is getting pre-qualified. So let me give you a little synopsis of the difference between pre-qualified and pre-approved, because you hear those terms all the time. They're used interchangeably. Pre-qualified means just that. We collect your information and we make sure that your situation meets the guidelines of the product and the program. Credit score, employment, debt to income ratio, there's that again. When you get pre-approved, that is just another level, and it actually gets submitted to an underwriter and they verify some information. So a pre-qualification letter, which is the typical one, it says Lori Gaudreau is pre-qualified for a loan up to $400,000 and subject to income and asset verification. A pre-approval is more of a conditional commitment that again, verified through the underwriter. So I feel like those terms are used interchangeably. More often than not, people are pre-qualified. Certainly, if we need more info, we will get that and verify it. And it's a bit situational. So why do you get pre-qualified? Well, you get a jump start on things, obviously. You can search confidently because now you know what you're pre-qualified for, what your payment range is. You're showing the sellers you're serious. But in this day and age, you really can't go to a showing or do anything without a pre-qualification letter. So 99% of the time, if you called and said, I want to go look at this house at 123 Main Street, they're going to say, okay, are you pre-qualified? So circle back. So that's why you start here. It also eliminates surprises. The worst thing is you find your dream house and you want to make an offer on it, then you get pre-qualified, or you find out that you can't get pre-qualified for some certain situation. And we'll get into that in a couple more slides, but it eliminates some of those surprises. So you can, again, go in there, be confident and know that you have your financing in place. And that's what the real estate agents want. That's what the seller wants. It just makes for a better experience. So that's where you start. When you hear get pre-qualified, that's where you start. It doesn't need to be scary. Some people are afraid of rejection because maybe your credit isn't where it needs to be. Well, you don't know until you know. So if you apply and try and you get denied and sent an adverse action letter, okay, that just means a not now. But we like to, and I like to, let you know what the steps are. How do you get your credit on track? So yeah, that's where we get started, getting pre-qualified. How much money do you need? So that's always the question of the day, because we get a phone call, we say, I want to apply for a mortgage. How much you have for a down payment will dictate what program you are going to go in or what options you have. You might have 3 loan options that you could do. You could do the 0% rural development because you qualify for that, but maybe you have more money that you can do a 3% conventional non-government loan and maybe have a better shot at getting the house. So it's really hard to kind of get into detail without having a 3-hour seminar. And again, some of these first-time homebuyers classes can be very long, especially the ones for Maine State Housing. They dig deep on every single subject. I just kind of want to cover the bases, and again, we can do follow-up after. I'm happy to do that to really nail down and dig deep. So closing costs, we hear that. It's 3% down plus closing costs. Okay, well, how much is that? Usually about 3 to 7% of the loan amount, depending on the program. And closing costs, origination fees, typically, that's the income, you know, doc prep fee, processing fee, appraisal fee, title search fee, the title settlement fee, credit reports, flood certification. They're all listed on there, and you know, they add up, but they're all necessary to be able to buy a home. There's closing costs, and then there's prepaid escrows, which basically we have to collect money to make sure that you have enough in your escrow account to pay taxes and insurance for the next year. So that all gets combined, and it's typically about 3 to 7% of the loan amount. Loan programs available. Again, I kept this one pretty loosey-goosey because there can be many, but what we offer, the first one is a conventional. It's called the CU Promise Loan, CU standing for credit union. It's a Maine credit union participation loan that behind the scenes, credit unions kind of get together and fund the loan to be able to keep it local. And we offer a 3% conventional and a 10% with no private mortgage insurance. We'll get to that on another slide. But I wanted to make mention of that particular product. We offer conventional, and I know you hear that all the time. All these words, government, conventional. Well, obviously conventional is a non-government loan. The government loans are insured by either FHA or Rural Development or VA, and we can couple them with Maine State Housing. If you want information on that, we are a lender. It's mainehousing.org. So write that down, mainehousing.org. We are a lender, but they will give you, that website will give you some good detailed information about their Advantage program that we offer. If you take the first-time homebuyer class, you can get $5,000 as a credit on your closing costs. Again, kind of too much to cover here, so I love to do some follow-up. We also offer construction loans, and I know that some people had mentioned that in their when asked. Construction loans are very popular right now because of the low inventory. But the problem is that most construction loans are what's called portfolio and require a heftier down payment. There's also what's called turnkey. So if you're looking for new construction, if the builder builds the house using their funds, then it's called a purchase upon completion or turnkey. Well, that's great because now it's really back to a purchase product. So let me know if you're looking at some new construction, and I can kind of tell you the different ways of getting that done. I also wanted to mention that we do offer mobile home loans, mobile home in a park, and land loans. I know I saw somebody had mentioned land loans as well, so we do offer that. What does a lender want to see? Well, stable income. And people did write that down. Self-employed, how can you get a loan if you're self-employed? Need a 2-year history. 2 years is that magic number in the mortgage world. When somebody is salaried or hourly, that's pretty straightforward. You get this amount of money every week and it doesn't change. But when people earn commission income, and that's the major part of their paycheck, or they're self-employed, the requirement is that you need a 2-year history because they'll do a historical average of that. What else does a lender want to see? Funds for down payment and closing costs. Bank statements, that's what we need. We require 2 months bank statements. Responsible handling of finances. That kind of says it all. They want good credit. We need good credit. And I think on the next slide is what people wanted to see as well, is how to establish and improve your credit. Establishing credit, you typically need, there's another 2-year mark on there. So if you don't have any credit, then you need to get a credit builder loan. You need to start somewhere. But rule of thumb is you normally need at least a couple, like 2 trade lines, 2 loans, trade lines reporting on your credit report for 24 months, or 3 trade lines for 12 months. That's considered like the basic minimum of thin credit. Improving your credit, that can be a completely different animal, because in my career, I feel like it takes about 0.2 seconds to kind of put the credit down the tube, and it seems like an eternity to get a score back up, especially if you're in the 600s to get to the 700s. Sometimes it just seems like eternity, but it does happen. I've been a witness and I've helped several people do it. It just takes time and patience. The obvious here, make your payments on time. If you've had some hiccups in the past, you've had some stuff going on and you've had late payments, credit reporting loves new payment history, new positive payment history, and it likes time. Doesn't work for us impatient people, but time is good. So the more time you have, the better. But the problem is if you have one little late payment after having a history of some negative, it's going to take your credit score and plunge it right down again. So be mindful of that. It's almost like you need to be obsessive about your bills and your credit and your credit cards. If you have them, they can get a little bit out of control. So just, you have to be obsessive about it. Make sure they are paid on time, get into a habit, do what works for you. Keep your capacity under 50%. Okay, what is capacity? Credit cards. They are a blessing and a curse at the same time, and they can be. You can get advice to say, well, you need to open up a credit card. All right, so you open up a credit card. Maybe it's a Best Buy credit card. You're gonna go buy that TV, and it's gonna help establish your credit because you want to buy a house. So you go buy the TV, that's $1,000, and they give you a $1,000 credit limit. Then I'm gonna go pull your credit report, and your credit score is gonna be down. And you're going to be upset, and it's going to be because there's a new trade line on there, which dips the scores down temporarily, but it's going to say proportion of balances to credit limits too high. You're maxed out on your credit card. You say, well, I was told to get a credit card. Told to get a credit card, but don't max it out. And definitely keep it under 50% because that is what takes points off of your credit score. And that can be manipulated. So you get a tax return, you pay down your credit card, your scores can go back up. Don't open too many credit lines at once. Yep, that can happen. I mean, sometimes you can even open one and it will temporarily plunge it a little bit. But when you're opening too many things, that can definitely affect your score. And the last one, so hard. Be patient when trying to improve it. It's tough. I know it takes time, but it can happen, especially if you have the right mix. Some people try to establish their credit and they open too many things. So they open too many credit cards. They go to Best Buy, they go to TJ Maxx, they open up every single credit card that they can, and then it makes it even worse because it's the credit scoring algorithms going, whoa, this person is opening too much, he's a risk. So another great slide, important things to discuss with a lender before it happens. If you are changing jobs. So changing jobs isn't necessarily bad and mean that you don't qualify, but it depends. So if you're a teacher and you're switching schools, no problem. You're in the same field, you're hourly or salary, not a problem. You're in the same field. In fact, the way that the employment is right now, people are getting sign-on bonuses to go to other employers. Problem you run into with changing jobs is if you're going from a commission type, or if you rely on overtime. If you are a police officer and you work loads of overtime and you want to qualify on that, and then you switch over departments, they're not going to guarantee it's the same department, same town. You're not going to, you need a 2-year history of overtime to count that. So that can definitely be a hiccup. Opening new credit products, we kind of went over that. That can also influence your debt to income ratio. So if you qualify based on X amount, and then right before you go under contract with the house, you buy a new car, well, we have to include that debt. That's going to show up. That could affect your debt to income ratio. Taking unpaid time off, that can affect things as far as the income stability. Changing the hours you work, that happens sometimes, unfortunately, with nurses, and they go from full-time and then they take a job somewhere else and they're per diem. And even though they have, and they can work how many shifts they want because there's such a shortage, the per diem, they do a historical 2-year average. So things like that can definitely affect the qualification. You definitely, before you do it, want to investigate that. And lastly, depositing cash into your accounts. Physical cash in the mortgage world is not good because it can't be sourced. So just be aware of that, especially if you're looking into rural development. There's income limitations on that. They will track Venmo deposits. So Venmo can be a problem because that is not easy to go on your app and source to prove that you don't have an extra job. So keep that in mind. And next, what's included in a mortgage payment? That's important. It seems kind of simple, but you hear the word PITI. Well, what is that? And you also hear the word escrow account. So let me break this down for you. Principal and interest, that's your loan payment. Just like a vehicle loan, if you went and got a car loan and your payment's $300 a month, some of that is principal and some of that is interest. But then, most likely, your mortgage is escrowed for taxes and insurance. So we take your annual taxes, property taxes, annual homeowners insurance, maybe flood insurance, and divide it by 12 and add that to your payment. That's your entire PITI payment. An escrow account, that word and phrase gets thrown around and people really don't understand what that is. It's really just a savings account that holds your property taxes and homeowners insurance each month. So every time you make a loan payment, some of that goes into a holding account. And then when your taxes are due the next year, or maybe in 6 months, the lender will pay that out for you. So it's good to have that knowledge because, again, when you're shopping for a house and we're giving you disclosures and we're saying these terminologies, we want you to understand what they are. So that is always helpful. What is mortgage insurance? Mortgage insurance, AKA PMI, private mortgage insurance. That also can be part of the PITI, principal, interest, taxes, insurance. Homeowners insurance can be flood insurance and mortgage insurance. It's different than homeowners insurance. It's designed to protect the lender, not you, in case you default on the mortgage. So mortgage insurance is when you hear FHA, it's insured by FHA. If you go into foreclosure, the insurance is protected by FHA. Again, it's added to your monthly mortgage payment. It can be temporary for conventional, or it can be for the life of the loan. And again, I can get into more details. If you have more questions, write them down. We'll follow up because this is just intricate stuff. We can go on and break it down, but I promise you that if you understand it, it's really just going to help you throughout the whole process and it won't be as stressful. Why should you have a realtor? I love this slide because I am pro realtor in what I see every day. And there's a big misconception when people are thinking about looking and going on a homeowner search. They don't want to contact a realtor because they think they're going to have to pay something. It costs you nothing. The sellers are the ones who pay the percentage to the buyer's broker and the listing agent for the commission. So please know that when you reach out and you find a real estate agent, they are going to help you find and search for a home, but it's not going to cost you anything. Typically, they know about the properties before they're listed. True story. When you go on Zillow and you see that dream house and it says for sale, then by the time you call somebody to get pre-approved, pre-qualified, and I look up the listing and it says sale pending. And then that is a dream crusher. And it seems to happen all the time. But some real estate agents, they're the buyer's agent. They sometimes know of properties that are going to be going on the market because they're working in the same office as the listing agent. So I have had it happen that a buyer's broker connected with the listing agent and my buyer got under contract when otherwise I don't think that he would have. They have great connections and experience. They help with tracking deadlines, paperwork, communicating with the sellers, and talk about a dream team. A dream team is when you have a great lender and a great real estate agent and a great relationship, and the communication is there. I can't stress enough about the communication. That's what it's about. When everybody's communicating, things are better. Even if there's nothing to communicate, it's something. So again, having a real estate agent, very important. So you're under contract, okay? You got pre-approved or pre-qualified. We gave you a letter. You have your budget. You know what it is, and you're going out and you're looking at homes. We know that's no easy feat right now because there's low inventory. There's just seems to be nothing out there. So hopefully spring has sprung. It's a beautiful day out today. Hopefully people are going to be listing their homes. You make an offer. So that's where it starts. You make an offer with your real estate agent and you're under contract. So now what happens? You get a fully executed purchase and sale agreement. And again, I know this is the fast track of the process, but I wanted to get something out to you. Copies of checks written, you're going to make a deposit on it. So you're going to make an offer and that's what you want to hear. You want to hear that they accepted your offer. You're going to write a check for the earnest money deposit. And then it comes to me and we celebrate. Yay, you're under contract. And this is where we are going to provide you with disclosures and we are going to ask you for some documentation, which I believe is on the next slide. If I have that right. Documentation needed. Sometimes we joke and say we need your firstborn or a blood sample, but it's just the way that it is. And if you know this ahead of time, then it's much easier. So I like to prep my borrowers and say, if you go under contract, this is what we're going to need. Sometimes people already give it to us, i.e. identification, you need a copy of your driver's license, recent pay stubs, 2 to 3 years W-2s, W-2s from your employers, and 2 to 3 years tax returns if you're self-employed or have any side businesses or rentals. And this is loosey-goosey because it's really going to depend on what program you are going through. Maine State Housing would require 3 years. But if you have all of this, especially the W-2s, tax returns, and obviously one thing missing on here is bank statements. That's the income needed. Bank statements, 2 months bank statements would be needed. Then it's going to be much easier. You already have it, you submit it, and then we provide you with the disclosures. So I think on the next slide, wrap up here, I put proactive and patient because it's usually a 45-day contract typically. That's the typical, sometimes 30 to 45 days. And there are times where you're just going to be waiting like, what should I be doing? And again, I'm going back to the dream team. When you're working with a great lender and a great real estate agent, you are going to know what you're waiting for. You're under contract, you submitted everything to me. We submit it to underwriting and you get an approval. It's a conditional approval. Great. We're going to let you know if we need anything else, and you provide it to us. It seems so easy. Appraisal gets ordered, the title work gets ordered. We go through this with you step by step by step, so you know everything that's going on. And my advice would be, don't hesitate to ask questions and know that our team is working behind the scenes for you. That is what's important. So as you can see, it's a lot. This is a lot. So you need to just break it down. And again, step number one, get pre-qualified or talk to us, have a consultation. You can talk to a lender without getting pre-qualified to see if you are even ready to do so. So I think the next slide will have my email address. And I know if we have time, we're going to answer some questions, but certainly elgaudreau@atlanticfcu.com. Feel free to reach out. It'll either be myself or one of the loan officers will reach out to you to have a conversation. It can be email, we can over the phone, we can set up an appointment, whatever is necessary. But spring is here, and we're hoping that the inventory will come back so people have a chance to go under contract. And next, I'm going to introduce my colleague, Dawn Post from Atlantic Insurance.
Awesome. Thank you, Lori. That was really, really cool, all that information you provided. And I can speak firsthand on purchasing a home and having to improve credit. The credit union was very instrumental in helping my fiance and I get things lined up so that we could get a home with financing through Atlantic. And we have been there for 5 years now, and we just love it. So kudos to your team. So I'll keep this short and sweet, because I know you guys are probably wanting to fill out home financing applications, but let's talk about insurance a little bit. I work here at the Atlantic Federal Credit Union Insurance. I've been in the insurance industry for over 30 years. Again, we will not go back to figure out what year that was, but it's been pretty interesting, and there's a lot of really cool things that we can do for folks depending on what you want to do for your home. So there are different places that you can buy home insurance. As you know, you can get it on the internet through direct carriers like Liberty Mutual or Geico. You can also go through captive agencies, which are Allstate, State Farm, AAA. And then we have independent agents like me that represent several different carriers in one place. And the advantage to that is when you call an independent agent, they can quote several companies at the same time and find the best deal for you within those carriers. They're also tend to have a good relationship with the underwriters of those carriers, and they can usually work out any nuances you might have that might be an eligibility exposure. So basically what you're insuring is the reconstruction value of your home. What is it going to cost to rebuild your home? Not to be confused with market value or the loan amount, because it's very different. It's what would a contractor charge to build that same house today. And as we know, post-COVID, a lot of things have gone up. Materials, labor has gone up because there's fewer people doing it. So all of those things come into play. It also ensures the items inside your home, everything that goes into the moving truck is included, as well as liability, medical payments if somebody gets hurt, and then any detached structures from your home. Things that we need to quote your home, most of it we can find online. If you're looking at a home in a town that doesn't have online tax cards, or the tax office isn't open 5 days a week, which happens a lot in little towns in Maine. Basically, we just need the square footage of the home. What year was it built? We ask for any dates that improvements have been made to any major systems, and that would be heating, plumbing, wiring, and roofing. And then construction style. What kind of home is it? Is it a ranch? Is it a cape? Is it a palace? Whatever it is that you're looking for, we would ask those types of questions. And then some other things that would be also questions we would ask is, what kind of pets do you own? Do you have any liability coverage needs? Do you have a business out of your home? Or maybe you have a home office, or maybe you're selling something, artist, or you're crafting something and people are coming and purchasing things from you. So we can talk about that too. And then any details about previous insurance claims at any location, whether insured or not, can also impact your insurance quote. So now for the fun part, and Lori had talked about different things that are included in your mortgage payment. And one of those things was insurance. If you are escrowing, or even if you're not escrowing, if you're escrowing, your insurance premium will be included in your mortgage payment. If you're not escrowing, you can pay for it yourself, and then you'd have your mortgage payment separate from that. Nationally, the average homeowner's premium is about $1,400. In Maine, it's $944. And if there's anyone here that's attending from New Hampshire, it's a little less expensive for $731. It has creeped up a little bit over the past few years, but again, that's indicative of the marketplace and the insurance values that have to be carried on the home to make sure you can be put right at 100% if something happens to your home. And that is, I told you I was going to make it short and sweet. So if you have any questions, or if you want to talk about a home that you're thinking about and you want to know what the insurance is going to run so you can kind of factor your budget, we're happy to talk to you about any of that. My name is Dawn Post, and my number and email is shown on the slide. We're here 8 to 5 weekdays, so please reach out to us if we can help you at all with any insurance questions.